Hey everyone, it's Will here with Flow Trade Effects. I'm bringing you guys a new video in the self-study series. This is going to be on consistency and how to approach consistency, how to add it to your personality and your approach to the markets. Specifically, we're going to be talking about the forex market in this video, but it does apply to both stocks and crypto. When it comes down to consistency, there's going to be several things that we're going to be taking note of. And I would say there's about maybe five essential things, maybe seven things, but five core things that we want to be keeping in mind when it comes down to finding or wrapping our heads around what consistency is in the market and how to add it to our trading personality. So when we think of, ourselves in the market, we think of consistency, we think of being able to adapt and being able to profit from the markets in all type of market environments, whether it's up or down. Now, when it comes down to consistency, I personally like to start with the edge. When it comes down to your edge, we're going to be thinking of, you know, like what exactly is your edge, for example. And an edge could be anything. When people get too specific on what an edge is, like, oh, I have to have a technical edge in the market, or I have to have a fundamental edge in the market, or I have to have some type of knowledge or information edge. Your edge could be whatever you're good at. And some people, they're good at numbers. They can add and subtract numbers in their head, multiply. They're good at simple arithmetic. So that could be your edge, particularly when it comes down to the speed in which you can calculate your risk management or your position sizing. Somebody else might have to take out a calculator, and then that little added few savings of seconds or minutes, whatever it might be, could make the difference. And I think that when it comes down to edges, it's kind of an ambiguous term that is up to the individual to define for themselves. Like, what are your personal strengths? What are your personal weaknesses? And kind of like maybe figure those things out as you go. And then keep note of them, like keep an actual little journal. We're going to touch note on the journal aspect in a later point. But for the first one, we're just going to be talking about like objectively identifying what your edge is. And I think my edge is being able to step away from the market and only take advantage of the opportunities that are familiar to me. So I would like to think that my edge is only taking the best setups that apply for me, like identifying my best setups. Like I can quickly identify when a market is looking like it's giving me my best setup or when it's kind of just doing something else. So that's one edge that I like to apply. And it's like a filter that I look through every single market. Now, I'm not going to be sitting up here saying I'm the best at math. I still take out my calculator to like calculate my risk reward. And then when it comes down to like information, I don't always check the news. I'm not necessarily like on top of all the economic releases that may come out. Like there's some weeks that I trade Fridays and I don't even realize it's NFP. So like I'll just be like, oh why? Why is the spread going so crazy right now? And then not even realize. But those things tend to not really affect me for my personality and my trading style specifically. But for some people, those things may play a big role in how you approach the market. Now, I would say that's number one out of our, 5 to 7 lists of things that you want to be mindful in, and that's going to be identifying your edge objectively. So you're going to be wanting to identify what it is that you're good at and how you use it in the market. So, like I said, mine is being able to filter out and find or cherry pick the best opportunities that apply to me, and I feel like that's something that some other people might not have, but at the same time, it could be very commonplace. Who knows? It just works, and my trading results seem to be fairly consistent. So that's why I'm sharing that with you guys to just say that um, I would like to think that you can objectively identify where your edge is And if your edge is in line with what you can or how you can apply it to the market, then you can move on to the next step, which is just simply going to be finding out exactly what your risk and reward or what your risk is going to be on every trade. Not even going to be talking about what your reward is going to be, just talking about what your risk is. So, for example, if you know that you have, say, $10,000 in your account, and with this $10,000, you don't want to risk any more than 1% or 2%, which would be reasonable, you know, 2%, 200 bucks, you can do a lot with that if you're trading it wisely. Now, when it comes down to understanding how to apply your risk to trading, it comes down to knowing what you're going to do with that amount that you would like to risk. So I have this chart example behind me, and I actually took advantage of one of these trades here. This was the AUD USD, and this was the chart most recently from yesterday to today. And I just want to point out this right here, and we're going to address this chart in several different cases throughout this consistency video. So that's why it's in the background. But yeah, so what I was saying about your risk. When it comes down to your risk, I have these color coded lines here: red indicating a stop loss, blue indicating an entry, green indicating a first take profit, and then the second green indicating a further take profit or current price, where current price was when I started the video. But so with these three lines, you have this blue line that I indicated here, which was your entry. So from your entry to your stop loss, which is simply just a pip or two over the most recent swing high area right here. So that's kind of the situation that we have here, and I'll explain why in a moment. But specifically when it comes down to your entry to your exit here of your stop loss, we have an entry of 69630, and then we would have a proposed stop loss of 69747. So that's about 117, well, not 117, but about 17 pips, give or take. And with that, you would just simply divide that number by whatever it is that you would like to risk. So, for example, if you wanted to risk $200, like we mentioned, you have a $10,000 account and you would like to risk 200 bucks, then you would go ahead and do 200 divided by the 117 that we have here, and then it will give you a number with a decimal place. That is your lot size that you would use for that lot or for this trade specifically. And then with your parameters set here, you would be able to place a stop loss, know exactly that you would lose 200 bucks on this trade if it doesn't go in your favor. And then this is where you would enter at. And then when it comes down to your exits, well, clearly we can talk about your exits later on in this video, but just know that you would be looking to clearly take at least a 1-to-1 or a 2-to-1 preferably ratio at the least to make it worthwhile. So you would be aiming for 2-to-1. With this being your stop loss, you would want to at least double that to the downside, given this was a short position. But we're going to be mentioning that in a later segment of the same video. But I just want to point out that when it comes down to your risk reward, or risk at least of this scenario, you want to be predefining what your risk is on every trade before you even go into the trade. So that's why I mentioned like your edge could be defining or calculating these numbers really quick, because as you can tell, sometimes these areas price can touch them really quick and then leave away from them really fast. So you have to be agile in the markets, you have to be nimble and quick. So sometimes being able to calculate things really quick is a big advantage in certain situations. But knowing what your setups are can also give you the confidence to be able to take a trade and then calculate your risk reward approximately more so while you know, really define the trade as it continues to develop. But you know, whatever your edge is and however it works for you, this is just an example of how to define your risk before you get into the trade. And then you'll understand exactly where your reward needs to be so that you are able to line that up with the market structure at the time and see if it actually makes sense to take that trade. Because sometimes the market structure and the opportunity might not work out, even if you're willing to risk what it is you're willing to risk. So you just have to be able to filter out these things as you're trying to attain consistency in the market. Now, once you objectively identify your edge, which was our first point, you're going to want to be able to define your risk on every single trade, which is the second point that I'm making here. And then I would say maybe even the third point, I would say maybe even the third point is like be willing to accept that risk. So like even if you enter the position, as soon as you press the parameters, you set them in place, the trade starts going against you and towards your stop loss, don't move your stop loss. You have to be willing to accept your risk because 9 times out of 10, if you're going to get in your own way and create a situation that deviates from a plan, it's going to fail and it's going to go against the plan that you initially set because you did it, because you stepped and interfered. Now, when I say this, I mean like that doesn't mean just start straight shooting every single chart that you find. I have previous videos that talks about how to filter and find good opportunities and trades, but when it comes down to like knowing what opportunities you're willing to take for the day, these are the ones that you're looking for. These might be on your watch list or what have you. These are the trades that you're going to be wanting to pay attention to and utilize your risk reward and accept that your risk may be hit, but your reward has just as high a possibility of being hit, if not higher, as long as you're taking advantage of opportunities that are, you know, in line with the market flow. So I would say that that is definitely a third point that you want to make sure that you grasp. Now, when it comes down to what we've talked about so far, we've mentioned objectively identifying what your edge is. Then we've talked about we've also talked about defining the risk on your trade, and then we've talked about accepting the risk on your trade. Now, the next we're going to be talking about being able to act on your edge or being able to enter your trades without any type of hesitation or fear. So, when I say this, I mean, honestly, we've all had those situations where we might have a slight impairment when it comes down to doing what we say we're going to do. Like the timing might not line up. You might be slightly frustrated. You might not be in the best mood. You could be tired. You could be sleepy. Whatever the situation could be, um, it really, really, really is important to try to be as consistent as possible when you're approaching the market. So I would say that it's even more important to make sure that you are in a good frame of space as opposed to feeling like you just have to make money for the day or just have to be in the market because of some type of requirement that might be outside of the market. Um, I want to say that again in maybe a slightly different way. Like when it comes down to it, like you want to be able to perform your best and be able to act without any hesitation or fear with a clear head. So if you have things that are in your life that could be distracting you from the market or being able to like fully be open to what may be happening in front of you, you want to address that stuff because it's not going to allow you to be as clear headed and as efficient as you possibly could be. Now, like, I'm not going to get too specific because we all have our own lives and we have things that may go on. But one thing is, like, a lot of people trade with the idea of, oh, I have to make money to pay my bills. I want to, like, live a lifestyle. I want to, like, upgrade my life. I want to do this. I want to do that. But, like, at the end of the day, like, Trading is really just a tool and it's an investment vehicle to grow your money over time. And like whether that time period is short or long, it depends on your investment experience and strategy and your objectives and goals. But like that doesn't necessarily mean that the market is going to give you those opportunities to do that every single day in abundance and in excess, especially if you're not really tuned in on how to like fully flow and go with the market. So I would say that like don't be focused on the money and try to be focused on the market. And if you're distracted, you're not going to focus on your strategy. You're not going to be confident in your ability to take your trade based on your edge. You're not going to be able to recognize maybe your best setups when they come through. So it just comes down to like address the things that you might have to address in your life. Trading isn't going anywhere. The market's always going to be there. You might miss out on some moves, but you shouldn't have FOMO, especially if you're living your life and you're doing your thing. And if you have experienced some type of trading success, then like you should be able to like live your life and kind of do your thing, and then know that the market is going to be there for you, and your trading strategy shouldn't change. You should be able to come back and do your thing as well. So I would say that your fourth thing you want to be mindful is your ability to act without hesitation or fear. And if you find yourself being fearful or acting with hesitation, think about your life and how that, you know, how life outside the market may be going. And if you have anything that might be taking up your mental space that could be distracting you from, you know, being able to see what the market is doing, you might want to do that first because, it sucks when you lose money in the market and you have stuff going on in your life and then it just feels like everything is falling apart. But like, it's not that deep. Just hold on to it. It'll all work out. But let's see. I would say the fifth thing that we're going to be talking about is going to be just continually monitor yourself for errors. Like when it comes down to like the last point I made, like addressing your life and anything that might be going on in your life, like you want to address that, of course. But this is a separate point. This we're going to be speaking on like trading errors that you might be taking. So, one moment. Okay. So we all make errors. Sometimes we might, you know, we might be eager to want to step into like a larger lot size or something because, we went on a good run and we think, you know what, it's time to start. It's time to step it up a little bit. We didn't jump too far ahead, but we want to make a little bit more use out of the moves that we're catching. So you might go into a larger lot size and jump ahead of yourself before you really like know what's comfortable yet. So you might be used to trading one lots, and then you decide, you know what, why not trade a two lot? And then with that two lot, the numbers start moving a bit quicker. Things start getting a bit uncomfortable because you know you start seeing double. And it's not because the market is moving any different than it normally does. It's just because your feelings of attachment with what you might be comfortable with, not even that you are not trading your system. It's just that you're comfortable with the way that your system might fluctuate. So it might go, you might have a certain level of drawdown that you're comfortable with. But once you start seeing the certain higher numbers and your drawdown is starting to be a bit bigger, then those things could impact your psychology or your ability to, weather the trade and let it like fully do its thing. So when it comes down to like just being able to like consistently check yourself, like you're gonna be able to find areas where you got like a little leak, where you might be like making a small mistake here or there, and like that was obviously a real vague, general, like kind of example of one error that somebody could be making. I've definitely made that error in the past. Like We'll talk about that in another video, but definitely just maybe let me think about some other maybe small mistakes that people might make that are easy to just check, you know? One of them could be stop losses that consistently get hit. Like maybe you are consistently getting hit with a stop loss and like the trade keeps going in your favor right after it. Something like that, you'll be able to check that and you'll be able to monitor that and you'll be able to see like, oh, why is my stop loss keep getting hit? Like maybe I have to have a slightly wider view. So I have this chart still up behind me here, as you can see. And here I have my entry as indicated by the blue line. And then we have the stop loss here in red indicated by the red line. And then let's say hypothetically, this market, instead of being held here within this red line and not exactly touching the stop loss, it went above here, got almost to this point right here where the market was previously at, this little high point, and then came back down to go for this whole run right here. Now, when you see things like that and they consistently happen, and say you're trading the same pair or what have you, then that just means you might have to slightly adjust your risk. Now, when I say your risk, I mean you would think like, oh, why won't you just extend your like take or your stop loss? Well, widening your stop loss skews your risk reward and it makes it so that your target of the day may be missed or slightly undershot if you're not necessarily utilizing the proper risk and understanding where your stop loss should be. Because when you when you move your stop loss from here to here, the calculation of your risk reward that we initially spoke about, where we risked 200 bucks and we divided that by the 117 that was for our stop loss. If we widen that up to here now, that becomes from 6.3 all the way to 9.93. So that's 30 pips. Our stop loss went from only just above 10 pips to nearly 30 pips now. So that changes what your lot size would now be. You get what I'm saying? So when it comes down to trying to just simply move your like stop loss just because, oh, you know what, let me just widen my stop loss. No, because if you kept your same stop loss here and widen your stop lot larger, your lot size would now, your loss might be like triple based on just moving the stop loss here. But your risk, but your take profit would still only be this. So you gotta like be able to adjust and understand how those things kind of impact you. And like being able to check yourself consistently just kind of allows you to see areas where you're not being as efficient as you could be, or simply see where you can be more efficient and just make a little adjustments to get back on track. And I would say I made a video about how journaling is super helpful and one of the most underrated aspects of trading, and what you could do to practice your trading at any given time is simply self-reflect, write yourself down, like write your thoughts down, kind of go back through your play-by-play of your trade, and like just simply write that stuff down as organically as it came out and then be able to review that stuff. You'll notice a few things with doing this. One, your trading results will improve. And two, your reflections about yourself become to get better. You start to reflect a little bit more in depthly, and then you start to see yourself in slightly more sophisticated ways. So I would say that journaling is definitely helpful, and it gives you a big reflection. Like even with these videos, I consider this like journaling almost in an aspect because I get to look back on my trade, I get to discuss them with you guys, and then I'm able to be like both accountable and yeah, it just works super cool, and I definitely enjoy this. But I would say I extend the same exact thing to you guys to like, start your journaling, maybe start videoing your trades and taking screenshots. And yeah, just looking for like ways where you can find like just be more efficient in your trading, whether that's losing less, protecting more of your capital, or just finding ways where you can earn more over time, but like do it in smart ways. And definitely another thing would just be to, well, first, before I move forward to the one of the last few things we're going to be talking about, let's just give like a brief overview of everything we just spoke about because we did discuss 6 things so far, or 5 things so far. Um, I would like to say first thing is first that we talked about is objectively understanding what your edge is. Mine is knowing and filtering what my best trading setups look like, are like, act like, behave like, and the features in which they exhibit. I know that. I filter that really quickly. I can see that, and I know if a chart has it or if it doesn't have it right away. And if it does, I'm into it. If it doesn't, I'm not. It doesn't take me long to do that. And I find that to be one of my edges. And I use that consistently every single day. If you guys look at my trading, you'll notice I'll give you guys an example of what one of my setups are. It is in this trade right behind me for you guys who actually watch my videos and pay attention. Um, you'll notice exactly here, I have the breakout, I have the pullback, and then the continuation pattern. I trade that every single time. Every single chart has this exact pattern. It comes out in various different ways, but I trade this every single time. I spoke about this in my price action video. Um, it's super simple to follow and find these opportunities when you're using price action. You can use it on bear charts. You can use other indicators such as moving averages as well if you would like to have other visual aids with this, but for the most part, price action is what I use. And I like to find these breakout, pullback, continuation patterns. They usually give high risk reward ratios and high probability setups. So I look for those, but I only say that to say that's my edge, and I use that to find trading profitability or trading opportunities with that. Um, the next thing we spoke about is predefining what your risk is on every single trade, and then being able to accept that was the third thing we spoke about. Another thing is being able to act on your edges, being able to take your trades without any reservations or fear. So if you do have things going in your life or anything that might distract you or make you hesitate while taking trades or feel fearful of your trading outcomes, then you might want to address those things before you take any more trades because they may impact your trading results in a negative way. I would say fifth thing we spoke about is to consistently monitor yourself for errors that you may be making. We all make errors and we are all susceptible to errors. Sometimes we get comfortable in a flow where we're profitable. We don't even realize that we're like maybe not doing the things that we may have previously be doing or been started doing new things that we just never really filtered or like considerably or fully added to the system. You know what I mean? So just being able to make yourself, you know, as bionic as possible, be able to like review yourself, give yourself framework updates, and like literally check yourself for errors. And then we spoke about journaling, videoing your trades, taking screenshots, and also writing yourself down. These are helpful ways to keep yourself accountable and will also help you find your errors and will also present ways where you'll probably be able to improve and impact your trading results profitably. So I would highly suggest that. And then finally, last but not least, we're going to be talking about consistency comes from doing something consistent every day. Now, when it comes to consistency, one of the most consistent things I've ever seen, most more so, and this isn't going to be actually, it's not even going to be the most consistent thing because I actually had to take it recently. It was the transit, city metro. Now, you see these things all over the city all the time, and without a doubt, they are consistently out there, rain or shine. They are on the road every day. Now, I say that to say they have specific times in which they're on the road every day. They have specific routes in which each of these city transit buses may take every single day. Not every bus is flying around the city, every single street, trying to pick up every single person, every single stop, every single place. That's just not reasonable. Now, I use this example to make the simple point that when it comes down to finding consistency, you want to keep it as simple as possible. You want to keep a consistent schedule. You want to keep a consistent arrival and exit time, regardless of what the market may be doing. And then when it comes down to it, I would say that keep a consistent mindset of improvement, regardless of how good you're doing. So, with all that, I would say that that is my approach to consistency. Um, it's relatively simple, but I like to break it down in this video that we went through. We did speak about several things here. I'm gonna just go through them one more time. First thing was objectively identifying what your edge was. Second thing was defining your risk on every trade. Next was going to be completely accepting what your risk is for every trade. After that, we spoke about acting on your edge or taking your trade without any fear or hesitation. Fifth, we spoke about consistently monitoring yourself for errors, and we spoke about how journaling is helpful in the ability to do that, and it will also help you find solutions. And then last but not least, we spoke about keeping a consistent schedule and approach to the market. That could be saying every day at 8 p.m., I'm going to arrive at the market, and then every day at midnight, I'm leaving the market. I have 4 hours to check, sit there, and do my thing. If the market is offering opportunities, I'm present. If they don't, I'm leaving. So keep a consistent schedule and keep a consistent approach, keep a consistent mindset, and your uh, aspiration to become better and improve as a trader and as an investor. Simply, I would like to think that following these simple things and knowing that they're practical but both essential to like attaining consistency, being able to consistency or being able to consistently make money, being able to consistently profit, being able to consistently see what your statistics are over time is definitely one of the most important things that any trader can want to attain as far as building a long, stable income or lifestyle based on trading and investing. It's going to come from consistency. And consistency doesn't come from wanting to make money every day. It comes from doing the things that actually puts you in a profitable position every day to make the money that you would like to make. So that's pretty much it for this video. I hope it was helpful. If you guys enjoyed it, give me a thumbs up. If you have any questions or comments, leave them below. If you guys like this content and you want to get more updates, please subscribe. It really helps. All in all, you guys stay healthy, stay possible, stay profitable, stay positive, and I will see y'all on the next video. Hold up. Peace.